kind of like this, there's kind of like, are there different levels? Is there like big picture, this is kind of what you want to own? Like kind of talk through how you would break that out.
Yeah. So the way to think about it, again, here at FDS, I like to just keep things simple with investing. I've been in this industry way too long. I have seen so many financial products come and go. When you boil it all down and you just look at it, it's like if you just invest in a simple mix of stocks, bonds, and cash, low-cost investments, you're going to do really well. So that's what we focus on. We don't get into a lot of esoteric, non-traded REITs, these real estate trusts that are out there, or whatever other products are out there. So we'll really focus on stocks, bonds, and cash to a lesser extent because we all know what that is. But if you look at stocks, what the purpose of having stocks in your portfolio is to give you growth above the rate of inflation. So we can go back 100 years. There's a lot of data on stock market returns over the long term. And if you look at stocks over the last 100 or so years, they have returned around 9.5% on average each year. That's absolute, or what they call nominal. I don't want to use a lot of jargon, but that means like after inflation, like 9.5%. I put $100 in at the end of this year. I would expect $109.50.
Okay.
Inflation tends to average about 3%. So again, I'll use a little bit of jargon here, but stay with me. When we talk about inflation-adjusted returns, we call that real returns. Okay. So if we kind of take that 3% out of that 9.5% long-term average for stocks, basically what that is saying is out of stocks you're getting 6.5% growth above the rate of inflation.
Okay.
So that the purpose of having stocks is to do that. You want growth because the more your investments grow, the less you technically have to save today to meet your future goals. When we get into bonds, the long-term average there is 4.7% in terms of total returns. You take 3 out for that. For inflation, you're getting real returns of 1.7%. So that is a lot less, but the purpose of having bonds in your portfolio is to generate income. So as you're maybe near a goal, whether it's sending a kid to college, they're in high school and you're getting ready for that, or you're in retirement, you want to have income and more stable investments so that the money is going to be there when you need it.
Yes.
And then you have cash, which if you look just over the very long term, the best you're ever going to do is basically the rate of inflation. So if you stuck your money in a mattress, you're going to lose 3% a year for inflation. If you put it in a bank account, maybe you'll keep up a little bit. But the cash is really there just to meet your most immediate needs.
Yeah. And even when we talk about cash, one of the hard things is you can invest in cash in different ways. There's your bank account, just a savings account, where it's like right now is still 0.001%.
Yeah.
When interest rates are at 3-4% in a high yield money market, just a money market account. Again, it's just two forms of cash earning very different rates. And so it's just paying attention to where your money is.
Yeah.
So that's really helpful. So we kind of have like this big umbrella. So we have maybe like stocks, bonds, cash. I guess within that, am I just buying like, okay, if I say I have 70% in stocks, am I just putting it all into one type of stock? Are there different types of stocks? Kind of just describe how you think about kind of under even that.
Yeah. So, I mean, there are a lot of different ways underneath those broad buckets of like stocks, bonds, and as you just said, cash. So you go to a restaurant, you order dessert, it's like, I want pie. And the waiter says, we have blueberry pie, we have apple pie, we have peach cobbler. I mean, you have to make a choice. It's not just, I want pie. You have to actually say what kind of pie you want. It's the same thing with stocks. There's U.S. stocks, big companies like Apple and Microsoft. There's small company stocks you've probably never heard of, but they're out there and they have stocks on the stock market. There's emerging market stocks. There's international stocks like out of Europe and Canada and more developed economies. So there's a lot of different ways. There's a lot of things on the stocks menu. And same thing with bonds. You have U.S. government bonds. You have corporate bonds, which would be, again, like Apple and Microsoft. They have bonds out there. But you also have what's known as junk bonds, which are very risky companies, but they pay really high interest rates to kind of account for that risk. So there is a lot going on underneath those big headings for sure. And, getting back to diversification, what we're always trying to do, all those different areas will perform differently over periods of time. So what we're trying to do is just make sure we have a good mix between everything that's available, or most everything, under stocks and bonds. And so that what you get with a good diversified portfolio is you get what you're trying to achieve. You get growth out of stocks, you get income out of bonds, but you're getting it in a way that is maybe a little less volatile than it would be if you only invested, you take somebody who owns like only one stock. It's like their entire fortune rests on the fortunes of that one company. So we really try to diversify that.
Yeah. And that's where even, we talk about all these different factors that investors have. Someone who, a lot of our clients have executive compensation. So we talk about like those are benefits that they're getting above salary or bonuses, but their company has said, hey, here's, a stock option or restricted stock. So we're going to give you company stock. And so that's a concentrated, okay, here's an amount just in that one stock. So how do I even fit that into then my whole, again, this big picture of if here's where I want to be, 70% in stocks, 30% in bonds, and that's just, we're just using that as an example. But how do I even fit pieces like that into it? And so it's all of that where this is what you need to keep in mind so that your money is there when you need it.